The following content is intended for use by retail investors and should not be reconciled with our fundamental research views or anything we discuss beyond slide 11 of this presentation. If you guessed our simple and systematic, completely systematic KISS portfolio construction process, you've guessed right. Let me give a brief overview of KISS. A lot of new clients in recent months and this year, which we're really grateful for, really thankful for. I think we're earning that ethos across global Wall Street in terms of the results that we've been delivering to you guys in your portfolios, and it's reflected in the growth of our community and our business. And so we're really humbled by that and really appreciative of that. But let me just give you a quick, brief overview of KISS for those of you who may be new. So KISS, we designed this 60-30-10 trend following strategy, specifically designed to outperform the standard 60-40 portfolio. So many investors out there in the retail space are getting fed a bunch of pie chart asset allocations from their investment advisors, or their a bunch of rolling pie chart asset allocations from their target date funds and their 401ks. And in our view, those are not great solutions for you, the client. They're great solutions for the people selling you those products, but they're not great solutions for you, the client. And so what we decided to do is create a great retirement solution for you, the client. And so how we do that, it's our factor selection. So we maintain the 60% equity exposure relative to that 60-40 portfolio, but we don't want that 40 being locked up in bonds. We allocate that 40 to gold and Bitcoin. And so for those of you who may actually want more yield out of KISS in terms of customizing KISS, our default exposure for the gold is gold, GLDM. You may allocate that 30% to a diversified fixed income ETF if you don't like gold, or a basket of fixed income ETFs that better aligns with your individual investment preferences, risk tolerance, or product availability if you're an international investor. Consult our discretionary risk management overlay for ideas if you're going to be swapping out gold and replacing gold with something else, or like fixed income, treasury bonds, et cetera. And then Bitcoin, our default exposure is Bitcoin there, 10% Bitcoin. Investors may allocate that 10% to the Bitcoin token directly, a basket of cryptocurrencies, or diversified physical commodities ETF, or a basket of physical commodities that better aligns with their individual investment preferences, risk tolerance, product availability. Again, consult our discretionary risk management overlay for ideas. So with this 40% we're trying to do in gold are twofold: capital preservation and sort of outrunning monetary debasement. And that's what we're trying to do in this fourth turning regime, of which we have identified as a high probability of seeing a tremendous amount of monetary debasement over the long term. So again, that's the factor selection part of KISS. And then the real reason why KISS continues to generate fantastic outcomes in your guys' portfolio and mine. Again, I use KISS to manage my entire liquid net worth, and have been since we authored this strategy since in January of 2023. And obviously I'm high-fiving myself in terms of the results that I've experienced in my portfolio. Darius Dell is definitely getting richer alongside you guys as well. I'm really grateful for that. But anyway, the reason KISS works to create such fantastic outcomes that you guys are experiencing, that I'm experiencing alongside of you, is the fact that we have our top-down risk management overlay, which is incorporating volatility targeting into the trend following strategy, and our bottom-up risk management overlay, which is incorporating dynamic position sizing into the trend following strategy. Vol targeting and dynamic position sizing are two of the hallmarks of institutional risk management, two of the core features that Wall Street sells to its clients for 2 and 20, 3 and 30, and so on and so forth, to help them manage risk. They don't sell this to you. They sell pie chart asset allocation and target date funds to you, and then they turn around and take your money and use it to build vol targeting and dynamic position sizing strategies for their clients. I think that's gross, and so we built KISS to fix that. So in terms of how KISS fixes that, just a few statistics I'll throw out to you for those of you who may be unaware. KISS has, if you look at this, so this is a rolling out of sample back test that begins in January of 2018. Each of the top down and bottom up risk management overlay pivots in this rolling out of sample back test are lagged by a full day to simulate real world trading conditions. So for example, let's say KISS generates a signal on Monday. In this back test, the trade will be executed at Tuesday's close, and it's consistently throughout the entire lifetime of the back test. And so, and there's roughly about an average of 2 trades per month in this rolling out of sample back test. So if you look at the average annual return of KISS, it does exactly what we told you it would do, which is demonstrably outperform the 60-40 portfolio, which is the most common pie chart asset allocation that investors are out there suffering from. So if it's 25% average annual return versus 10% for 60-40. And then if you wanted to compare KISS to just a naked long portfolio that's always fully invested, 60-30-10 stocks, gold, Bitcoin, the average annual return for that strategy would be 28%. So KISS is doing exactly what it's supposed to do relative to 60-40 with a 258% upside capture ratio. But where I think KISS really shines to me is on the drawdown and volatility characteristics. KISS has a max drawdown of minus 12%, and it's the only double-digit drawdown in the lifetime of this rolling out of sample backtest. If you look at 60/40, it has a max drawdown of 22%, which has occurred twice in this backtest. And then if you want to compare KISS again to a naked long portfolio of 60, 30, 10 stocks, gold, Bitcoin, the max drawdown for that strategy without our top-down and bottom-up risk management overlays is 25%, and it's crashed three times since January of 2018. And so essentially, KISS has eliminated two crashes in your portfolio if you were relative to 60/40. It would have eliminated three crashes in your portfolio if you want to just be naked long 60, 30, 10 stocks, gold, Bitcoin. So that's where the downside capture ratio for KISS relative to 60/40 is 54%. And the downside capture ratio of KISS relative to 60, 30, 10 stocks, gold, Bitcoin is only 49%. So this, in my opinion, is where KISS really shines and why we have so many investors using this system to retire on time and comfortably. So super proud of this. Super proud of each of you for figuring out that there, in fact, is a better way to invest than stupid pie chart asset allocations and rolling target date funds, which are essentially a series of rolling pie chart asset allocations based on your age. I couldn't think of a sillier collection of products to market to people if your goal was to actually get them to retire on time and come to. But I guess, actually, I'd take that back. Pie chart asset allocations and target date funds are better than what most retail investors are doing in the absence of those things, which is winging around a bunch of poorly researched trade ideas. But I would rather you pie chart asset allocation and target date fund. But I would much prefer you to KISS because you're going to retire on time and comfortably way faster with way more money than you would if you were going to be long 60/40 or anything like that, like a target date fund. So just be aware of that.